All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world. Happy Thursday, everybody. Today's August 13th, 2026. And our top story this morning, inflation once again lower than expected. We got the producer price index, or the PPI. Certainly doesn't get nearly as much attention as CPI, but it came in down sharply from June's number for the month of July and lower than the market was expecting. This follows yesterday's CPI that came in line with expectations, but also down from prior months, and the market breathed a big sigh of relief on that news. And so this is further, I guess we'll call this good news. And again, I know I get this in the comments every inflation day. Yes, guys, I know government data, unreliability, they lie, all that stuff. I get it, but the data is the data. We're going to just report it as it is, because if I just start reporting what I think it should be, well, then what's the point in reporting anything? July PPI came in at 4.7% year over year, still more than double the Fed's arbitrary 2% inflation target, I might point out. But that's versus market expectations of 4.9% and down sharply from 5.5%. And you'll see in most of like the core numbers and the month over month numbers, they were all more or less lower than expected and down sharply from last month. So producer price for July, not surprising. We had the big drop in oil prices in June because of the memorandum of understanding, which is now obviously far in the rearview mirror. But, look, this is another data point that supports inaction at the Fed. And, take this on top of the CPI that we saw yesterday, which, despite being the 65th consecutive month of missing the Fed's target, it was in line with expectations and down. Inflation is, at least according to the government data, trending in the right direction. Meanwhile, employment is trending in the wrong direction with that disaster of a jobs report that we got last week. And so if you're Kevin Warsh, you look at that and you say, I'm not going to hike rates at the next meeting in September. The market is starting to reset that expectation. And, look, if you're Kevin Warsh, this is good news for you because you're stuck between a rock and a Donald with the whole interest rate thing. And so Warsh would like nothing more than to just do nothing. He talks a good game, though. He says all the right things at meetings. And these days in corporate America, that's enough to get you to at least a middle management position. Also, interesting news yesterday. U.S. crude inventory shot higher. The biggest inventory build in years for U.S. crude oil. I did not see that coming. I don't think anybody saw that coming, except maybe Doomberg. Doomberg maybe saw that one coming. Doomberg is like the one oil bear that has been consistent for the last several months since this conflict began. But crude inventory way, way higher. 17.4 million barrels added for the week ended August 7th. Now, keep in mind, this is commercial inventory. So this is outside of the Strategic Petroleum Reserve, doesn't include the SPR. The SPR did fall by 6.1 million barrels that month. So basically that during that week. So that 6 million barrels came out of the SPR and went into commercial inventories. That still doesn't explain the 17.4 million barrel build. We imported more and we exported less. So the oil market is a little bit softer than Middle East headlines would suggest. The data is the data. And again, government data, grain of salt. Hey, maybe they're fudging the numbers. Wouldn't be the first time. But let's assume for a second the data is right. That's very bearish for oil prices. Oil barely moving today, though. Now, as this is all going on, we've got Iraq is apparently paying Abu Dhabi to sneak their oil out of the Strait of Hormuz, and a lot more is getting through than people realize. Certainly more than the headlines and some of the more bearish takes would suggest. A lot more oil is getting out of the Strait these days, if this article is to be believed. And hey, maybe that's why U.S. exports were down a little bit, and maybe that's why we had that crude oil inventory build. Maybe the market is starting to settle into whatever the hell the current situation is in the Middle East, and they're just saying, you know what, we'll pay these crews enough to risk their lives to sneak the oil out the Strait, take their chances with the Iranian drones, and just hope for the best. Maersk is certainly making money off of it. Maersk just reported that they are They're making a lot of money off of these bottlenecks and choke points being attacked, taking the long way around Africa. They have raised their guidance again. That is the second time since June Maersk has done this. That stock is ripping this morning. We got a wild story yesterday about the Panama Canal. I don't hear anybody else talking about this, but this is pretty crazy. The auctions for the transit fees to traverse the Panama Canal hit $1.1 million at their most recent auction. 1.1 million. That is an all-time high, and that is 16 times the amount it was going for a year ago. Not 16% higher, 16x higher. Guys, what's going on there? Well, obviously what's going on in the Strait of Hormuz is playing a role as more U.S. crude is going through from the Gulf is going through the canal and then over to Asia, although that was down for the most recent week, we just talked about. But there's something else going on there. And it's something that maybe it's still like medium term. It's out there a couple of months, maybe even a year. But there could be a really big story hiding in this Panama Canal auction that I think people need to start paying attention to. We've been talking about this on my Patreon Zoom for a couple of weeks now. I think it's time that we start talking about this one. So stick around for the middle of the show, that one. We also got home sellers way outnumbering home buyers now. You'd think that would mean lower prices. And in some areas, some markets, that does mean lower prices. But prices are not reacting the way they should. Housing market remains frozen, but I don't think it's going to be that way for long. And I think when it thaws out, people are not going to like what they see. Unless you're a young guy looking to buy a house. Then light at the end of the tunnel. The LA Lakers could become the most valuable franchise in history, the most valuable sport franchise in history. Bob Iger and Josh Kushner, who apparently are friends, I didn't know that. Bob Iger, former Disney CEO, and Josh Kushner, the brother of President Trump's son-in-law, his cousin's brother's former sister's former roommate. They're buying the LA Lakers, or at least they have bid $12.5 billion for the LA Lakers. And assuming that deal closes, that would be the highest price paid for any professional sports team ever. Wow, that's kind of neat. And then you realize the dark side of this story, the reason why the Lakers are for sale in the first place is because the Lakers' current owner, Mark Walter, who also owns the LA Dodgers, he got caught with his hand in the insurance cookie jar. Something I've been warning about on this channel for years. Messy story going on over there with the Lakers. And last but not least, we've got to talk about Egan-Jones. Speaking of what's going on with insurance and with private credit, U.S. regulator has denied Egan-Jones' request to expand their ratings business, which is kind of funny because, we've got $500 billion, $500 billion of data center asset-backed securities that are about to hit the market thanks to NVIDIA, and the most grotesque example of moral hazard I've ever seen with all those Wall Street guys who are loaning them the money or arranging the financing for NVIDIA to backstop to inflate their own sales. $500 billion of that crap is about to hit the market. And Egan-Jones is like, oh, I can't wait to rubber stamp this stuff for a fee. And the government's saying, no, go away. We know what you're doing. You can't do that. Egan-Jones is a firm that had previously in 2025 with a team of just 25 analysts somehow rated 3,200 private credit deals. I'm sure using the most rigorous standards and thorough deep dives, 25 guys, 3,200 deals in a year. Give me a break. And with all this data center crap hitting the market, they're like, SEC, can I rate some of those? And the SEC said no. So, hey, SEC, thanks for coming in today. It's good to see you guys showing up at work for a change. Guys, why don't we just shrink my big melon head and let's see what's going on in the world of finance today, shall we? Hey, don't forget the like button. Don't forget that subscribe button for the algorithm so you can come back tomorrow and have your coffee with the melon heads because we do this every day. Right now, the S&P 500 is higher by 22 points or 0.29%. You'll notice here right around 8:30. That was the PPI report, so the market did start trading higher on that one. The Dow is up 177 points or 0.33% in the green this morning as well. The NASDAQ is up 55 points, 0.19% in the green. All three indexes are up. We've got the dollar is weaker again this morning, 99.85 or 0.14% lower. 14 basis points down. What's going on here? This is probably PPI. You'll notice right around 8:30, it took a little bit of a nosedive there. Again, the lower than expected PPI inflation probably means a less aggressive Fed. That probably means a weaker dollar. And bond yields are lower as well for the same reasons. 30-year Treasury, 5.218. That's off by almost 3 basis points. The 10-year yield is at 4.631. That's off by 6 points and change. Big drop in the 10-year this morning. 2-year yield, 4.151. That's off by almost 5 points. And the 1 month is at 3.669, down a point and change. Also, speaking of bonds, is worth talking about this one here. U.S. budget deficit widens in July on higher outlays and negative tariff receipts. Remember that whole thing about like the government spends too much money? Are we still talking about that? Oh, no, we're not. Well, then allow me to ruin that. U.S. federal budget deficit for July jumped to $432 billion in just a month. That is a record for the month, as higher outlays and more negative tariff revenues also brought the 2026 fiscal year-to-date budget gap to almost $1.8 trillion, on pace to hit $2 trillion in debt spending this year. That tops the full fiscal 2025 deficit with 2 months left in the year, the U.S. Treasury said on Wednesday. The biggest culprit here, or at least the culprit adding to the increase, is tariff refunds. The U.S. has now refunded about $100 billion of the tariffs we collected last year. There was $166 billion collected, so we've probably got about 2 months of those big tariff refunds ahead of us. Hey, anybody remember when we were going to cut spending, talking about that thing? Like, hey, maybe the government should spend less money. What a novel concept. And then we had that whole Doge exercise, and everybody was like, oh, my God, they cut USAID, and they're laying off federal employees. Yeah, it didn't matter. Budget deficit went up. Spent more money anyway. So that's fun. Hey, how about the commodities board? We've got gold is lower by $14 this morning, $4,394. Gold just gave up that 4,400 level, but still, gold has had a heck of a run these last few days, down 0.33% this morning. Spot silver's at 65.25, down by about a dime or 0.15% lower, briefly touching $66 this morning. Hey, that's neat. $65.23, not bad. I like the shiny. Copper is higher by 0.13%. Platinum is lower by 1.7%. We've got palladium is lower by 3.5%, 3.6% now. Big drop in palladium this morning. And WTI crude is lower by $2.30, 2.77% lower, just below $81 for September WTI futures on that big inventory build, which we'll talk about in a few moments. But first, let's talk about the producer price index. PPI for the U.S. increased by 4.7% in July of 2026 over the same month in the previous year. Market was expecting 4.9. So, 4.7, too high. In my opinion, anything over 0 is too high, but the Fed says anything over 2 is too high, and we're at 4.7, but the market was expecting 4.9, and so this is good news? Yep, this is what passes for good news. Hey, it's down sharply from 5.5% in June and the 6% we saw in May, so at least it's not that. Trending in the right direction. On a month-over-month basis, nothing. U.S. producer prices were unchanged in July of 2026. Excuse me, market was expecting higher by 0.2, so that's a beat as well. But that is up from the negative 0.3 that we saw in June. Again, the big drop in oil prices in the MOU that we had in June. That's why we got that big drop there. On a core basis, when we strip out the volatile food and energy, core PPI decreased to 4.2% for the month of July. That is in line with expectations and also down rather sharply from the 4.7% that we saw in June. And core month-over-month PPI was 0.2%. That's actually, month-over-month, the market was expecting 0.2, so that's pretty much in line. And, down from 0.4%. PPI lower than expected. Let's look at what that means for Fed interest rate decisions. This is the CMI Group's Fed Watch tool. Let's refresh this and get an accurate mark because it changes on inflation days. All right, right now there is a 67, we'll call it 68% chance that the Fed does nothing once again at their next meeting, just a 32% chance that the Fed hikes by 25 basis points. That is for the September FOMC meeting. And looking through the end of the year, as of coming out of the December Fed meeting, right now there is a 32% chance the Fed does nothing for the rest of the year, a 45% chance we get one rate hike, a 20% chance we get two rate hikes. And that little guy, 3% chance of three rate hikes, I wouldn't worry about that little guy. All right, now let's talk about the crude inventory build. It was big. It was, matter of fact, the biggest in 3.5 years as exports slump. Some unexpected softness in the oil market. U.S. crude stocks, excluding barrels in the Strategic Petroleum Reserve, posted a surprise build and made their largest weekly gain since January of 2023 last week as exports slumped, the Energy Information Administration said on Wednesday. Crude inventories rose 17.4 million barrels to 424.4 million barrels for the week ended August 7th, their highest level since June 5th. And that's compared with analysts' expectations in a Reuters poll for a 1.4 million barrel draw. All right, inventories were supposed to drop by 1.5 million. They rose by 17.5 instead. Slight miss there by the analysts and their expectations. Ongoing weakness in crude exports has combined with a massive jump in imports to drive on the second largest crude inventory build in history. Yikes. The second, was anybody out there? No, nobody was expecting the second biggest inventory build in history. Now, keep in mind, this is after months of inventory draws, so it's not like we've got a suddenly oversupplied oil market, but this is a big sigh of relief here. The vast majority of the build happening on the Gulf Coast. I think probably imports from Venezuela playing a big role here in the surge in imports. And obviously, they're saying we're exporting less here. Now, we've got some commentary here. This week's report shows a big inventory build, which looks anomalous. Exports were unusually low and imports were high. This would be bearish for oil if more builds appear in the future. Thank you, Captain Obvious. But seems more likely to be a one-off, said Josh Young, Chief Investment Officer at Bison Interests. Net U.S. crude imports rose by 1.7 million barrels per day, the EIA said, their highest since June of 2025, with imports from Canada and Venezuela hitting multi-month highs. Today's numbers are very noisy because of tankers unloading in the U.S., but they don't alter the challenging fundamental picture. The SPR continues to shrink, and gasoline was drawn down. Markets will likely look past this report and keep focusing on headlines out of the Middle East, said David Russell, global head of market strategy at TradeStation. All right, so the SPR draw, again, it was 6.1 million barrels for the same week. So we did have more oil came into the country than went out, even when factoring for the SPR draw. Biggest in 3.5 years, second biggest in history. A lot of oil suddenly appeared. All right, let's assume this is right. Let's assume it's correct information for a second. Maybe that's a big assumption. Oil market not nearly as tight as people think. And here you can see it in the data. There's that 17.4 million barrel build that we saw in August. We had also a pretty big build back in February, but the market was expecting another negative number. And you can see here pretty much since April, we've had a lot of inventory draws. Thanks in no small part to what's going on in the Middle East. And speaking of the Middle East, Iraq says Abu Dhabi's ADNOC among buyers of its oil. Iraq's oil marketing company said Abu Dhabi's main energy company was among firms buying its crude and sending cargoes out through the Strait of Hormuz. ADNOC is one of the buyers SOMO deals with, along with other companies, said Ali Nazar, Director General of SOMO, in a text message. He added that the company has been selling to whoever can load oil onto ships and exit the Strait of Hormuz. Abu Dhabi's National Oil Co., or ADNOC, their trading arm, is offering Asian buyers Iraqi supply by shutting cargoes through Hormuz, a playbook that then typically involves transferring the cargo to vessels just outside the waterway, Bloomberg reported on Wednesday. This method, often involving tankers switching off their transponders to avoid detection, has ensured Middle East oil continues to flow to the global market. Iraq's oil exports via Hormuz jumped to about 2 million barrels a day this month, Nazar told Al-Ahad TV this week. While that's a jump from the levels during the months following the start of the war, it's still below the 3.4 million barrels a day that the country was shipping in total before the conflict. All right, so that's some pretty good numbers there in that paragraph. 2 million barrels a day just from Iraq is getting out of the Strait. That is way more than most people realize. Certainly not enough. We were at 3.4 million at the start of the war, but more than half of that capacity has now come back just by people running the gauntlet, taking that risk. All right, that is way more than I think the market realized. And if you were to extrapolate that based on the 20 million barrels of oil per day that we had pre-war going over, right? So you're probably looking at somewhere around 12, 13 million barrels a day is still getting out of the Strait of Hormuz, either through running the blockade or being routed out around it through other means, either rail, pipeline, or truck, or whatever they're doing. A lot more oil is getting out than people think. That's the takeaway here. And maybe that's partially responsible for why the U.S. inventory built so much in this week that nobody was expecting. But Maersk is cashing in on it. Maersk shares rise as higher freight rates trigger guidance raise. The company expects the global container market to grow by 4% this year. A.P. Moller Maersk shares rose after the Danish shipping company raised its full-year guidance for the second time in less than 3 months, citing higher freight rates and strong demand in Asia. And European trading shares were 5.4% higher, having risen as much as 8.7% earlier. Shipping companies have been grappling with the conflict in the Middle East, which has disrupted key shipping routes, forcing carriers to divert vessels around Africa and absorb higher fuel, insurance, and operating costs. Maersk benefited from strong market demand in East Asia and higher spot rates, while increased costs stemming from the Middle East conflict were offset by commercial measures, it said. Means they raised their prices more than their costs went up, so their profitability is going up. Dare I say a little bit of price gouging there, Maersk? The company now targets underlying earnings before interest, taxes, depreciation, amortization for the year of between $10.5 billion and $12.5 billion. That's higher than the $8 to $10 billion that they had previously guided. They also raised their guidance for underlying earnings before interest and taxes to $4.5 to $6.5 billion. That's up from $2 to $4 billion. These guys are making bank here. Wow. Company had already lifted its annual forecast in late June due to strong demand and rising freight rates. So the shippers, they are cashing in. A.P. Moller Maersk shares higher now by 9%. This is priced in DKK. I think that's Danish krone is the currency here. But Maersk shares sharply higher this morning. All right, keep an eye on this story. This one in Seoul Economic Daily. I'm kind of surprised this one hasn't reached Western news yet. Panama Canal toll auctions hit record $1.1 million to cross the Panama Canal. The cost of passing through the Panama Canal, a key gateway for global maritime trade, has soared to record levels as unusual weather has lowered water levels and cargo traffic diverted from the Middle East has made the shipping lane scarcer. The average winning bid at auctions for slots through the canal's main locks reached about $1.1 million this month. That's according to the Financial Times. That is more than 16 times the level seen during the same period last year. Holy shit. 16x increase in transit fees for the Panama Canal. The price surge gained momentum after the U.S. and Israel-led bombing of Iran, which began on February 28th and closed the Strait of Hormuz. But climate factors have compounded the pressure. Rising sea surface temperatures in the Pacific have driven an El Nino event that began strengthening in June. The U.S. National Oceanic and Atmospheric Administration, or NOAA, expects this year's El Nino to be stronger than usual. That's an understatement. As a result, falling water levels in the canal have reduced how much cargo ships can carry, raising the likelihood that the number of crossings will be capped in the second half of the year and push prices higher. Guys, this super El Nino that is brewing in the Pacific right now, we haven't talked a lot about this on the air, but we have spoken about this on my Patreon Zoom for a couple of weeks in a row. It is setting up to be one for the record books. It's not quite that level yet, but it is strengthening significantly. That will affect global rainfall in certain areas, more in some places, much less in other areas. Super El Ninos in the past have caused significant economic disruption, and already it is causing people to outbid each other for space in the Panama Canal because they're worried they're going to limit the number of crossings. because transit through the Panama Canal is dependent on the water level in this lake that is right in the middle of Panama. And every time these ships traverse these locks, they consume water from the lake. And so if there's less rainfall than expected because of a super El Nino, the lake level drops. They don't have enough for the ships to keep crossing. So they start limiting the number. That has caused, along with the Iran war, which is probably still the majority here, but a 16-fold increase in Panama Canal transit fees. That El Nino, guys, I think as the months get ahead, dust off your Chris Farley El Nino memes. That's all I can tell you guys, because we're going to be hearing a lot about this one in the months ahead. Home buyers, pay attention here. U.S. housing market tilts hard towards buyers. U.S. home buyer demand hit a record low in July with just 967,000 buyers versus 1.46 million sellers, a 51% seller surplus. Somebody want to help me out? What happens when there's more sellers than buyers? Anyone? Nearly 80% of major metros are now buyers markets, giving house hunters greater negotiating power. Miami leads with 154% more sellers than buyers, followed by Nashville and several Texas metro areas. All right, so Florida, Texas, Tennessee, maybe we'll throw Las Vegas in there too. Those are the markets that typically lead either booms or busts in real estate, and they're seeing the biggest moves here. High mortgage rates, elevated prices, and economic uncertainty are keeping buyers on the sidelines. I would also add higher property taxes and higher insurance costs are also contributing here. People can't afford the homes that they used to be able to afford because the towns and the insurance companies keep jacking up their rates, because on paper, their home is worth so much more money than it used to be, even though there's pretty much nobody willing to buy it from them for that price. All right. Housing bears rejoice. Looks like lower prices are coming. All right, now on to the LA Lakers. Iger and Kushner landed Lakers deal in a day. No bankers needed. LA Lakers, look at this. Thrive Capital founder Josh Kushner and former Walt Disney CEO Bob Iger were busy all summer working on a bid to acquire a National Basketball Association expansion team for Las Vegas. The pair discussed mascots, team names, logos, and an arena. And then they decided to see if the LA Lakers, majority owned by investor Mark Walter, might be for sale. Through an intermediary, they reached out to Walter, who had been facing federal scrutiny over how he classifies investments made by his insurance companies. For Iger, a lifelong basketball fan, a longtime Los Angeles resident, the idea of owning the team that had been home to legends like Magic Johnson, Kobe Bryant, Shaquille O'Neal, how you not going to mention Kareem Abdul-Jabbar, though? Come on, guys. Was too much to resist. Kushner and Iger made Walter an offer he couldn't refuse, $12.5 billion, over $2 billion more than what the Lakers had been valued at when Guggenheim Partners co-founder bought control of the team last year. The deal, which is not yet closed, would mark the highest ever price for a sports team. Talks and negotiations took a matter of a few days, with the final deal coming together in the past 24 hours, according to Iger. The group managed to keep the discussions private. All right, so why are they doing this shotgun wedding sale of the Los Angeles Lakers for $12.5 billion? The deal coming together apparently like over the weekend. Well, it's probably got something to do with this. Federal probe in the Dodgers owner's financial empire was sparked by a whistleblower. Authorities are examining about $16 billion in private credit deals involving Mark Walter's insurance companies to determine whether fraud occurred. Oh, if only somebody had been warning about private credit and insurance fraud for the last, 3 years. The problems with Mark Walter's sprawling sports and finance empire began with an internal whistleblower complaint. The complaint questioned how Walter's asset management firm, Guggenheim Investments, booked revenue from dealings with insurance companies and had drawn interest from federal prosecutors by last year, people familiar with the matter said. Within months, the investigation evolved to focus on investments in private credit, a lending business that has boomed on Wall Street in the past decade, and half of which supplied the financial firepower for Walter's 2012 acquisition of the LA Dodgers alongside partners. The U.S. Attorney's Office in Manhattan and the SEC are now examining how around $16 billion in loans extended to companies tied to Walter or his conglomerate, TWG Global, wound up on the books of insurance companies that he owns after passing through a third entity, the people familiar with the matter said. The authorities are trying to determine whether the activities constituted fraud. Of course they did. Such related party transactions must be disclosed to insurance regulators, a rule meant to limit conflicts of interest and protect policyholders. Walter's insurance firm said in recent filings that they had reviewed their transactions after receiving subpoenas and had identified problems with how certain transactions were presented. Sorry. In hindsight, it turns out we did do the crimes. We're real sorry about that. Gosh. So what are they talking about here? How did these assets that were sold by Walter's companies end up on the balance sheet of Walter's insurance companies without being reported to regulators, because those are related party transactions? In other words, a big conflict of interest. Well, he used a third party. And I think we're going to find that many such companies did this. What you do is you sell the assets to some guy, and then 5 minutes after that deal closes, some guy sells those assets to your insurance company. He only owned them for the time it took him to sign on the next page. But I didn't sell directly to my own insurance company. I sold to him, and so I don't have to report that transaction to regulators. Yep, that's fraud, all right. I mean, why are we even talking about this like it might be fraud? The investigation comes as regulators are starting to take more interest in the opaque world of private credit, which took off after the financial crisis of 08 and 09 and has become a rival to banks in extending loan to businesses. Yet private credit, the whole industry was created because we made all this shit illegal in 2008 and 2009. And then the banks were like, we'll just loan to somebody else and they'll do what we can't do with our money. And we'll call it something different. We'll call it private credit. A big chunk of the money fueling that industry is coming from life insurers, such as the ones Walter owns. Other big private credit companies like Apollo and KKR have snapped up insurers to buttress their businesses. Regulators are wrestling with the arrangements, which have led to a surge in affiliated transactions where the private asset firms are managing the investments for their insurance units. Walter co-founded Guggenheim Partners and helped engineer the purchase of several insurance companies hobbled by the financial crisis. In time, those insurers began to finance a series of investments controlled by Walter and his partners. Later, Walter transferred his controlling stakes in two of those insurers, Delaware Life and Clear Spring Life and Annuity, into a new holding company called TWG Global, short for the Walter Group. TWG also houses Walter's portfolio of stakes in sports teams, along with other financial businesses. Guys, all I can tell you, if you or maybe one of your parents or somebody you love has an annuity or any kind of a whole life insurance policy, do your homework, double check, make sure private equity firms haven't bought out that insurance company and loaded up its balance sheet with their dog shit assets. If they have, that means that you are now the bag holder for this crap. And the owner of the LA Lakers got caught doing this, and that's why he's suddenly selling the Lakers to Bob Iger and Josh Kushner, because he got caught with his hands in the insurance company jar. That's something I've been warning about for years, what private credit, private equity is doing. And here's another example of it. Meanwhile, U.S. regulator denies Egan-Jones bid to expand ratings business. Egan-Jones is one of the firms that is directly responsible for this. Do you remember the scene in The Big Short with the lady with the giant glasses at Standard & Poor's at the ratings agency, and Steve Carell is sitting there and he's like, this is ridiculous. How can you be rating these things AAA? They're full of defaulted loans. This is ridiculous. You know, the ratings agencies are whores and they'll rubber stamp anything AAA. Well, Egan-Jones takes that scene and they made an art form out of it. The Securities and Exchange Commission rejected credit rating firm Egan-Jones' application to re-enter the market for grading government debt and asset-backed securities, the largest sign of regulatory pushback against the small but prolific agency. Egan-Jones' application contained material inaccuracies, the filing said, including certifications that were years out of date from what the SEC called qualified institutional buyers. The U.S. regulator said it had to reject petitions if a firm doesn't have adequate resources to consistently produce credit ratings with integrity and to comply with specific statutory standards. And apparently this crew of 25 guys did not have sufficient resources to ensure integrity in their ratings. We sought the 2 additional licenses at the request of clients and expect to be able to address any concerns and look forward to serving the market, Egan-Jones said. Yeah, Jensen Huang and all these other asset managers out there that are looking to dump data center ABS on the grandma's insurance company, but they need a AAA rating to do it first. They were trying to hire this rating shop, Egan-Jones, to rubber stamp and do it for them. But the SEC, in a shocking turn of events, the SEC has done their job and said no. Egan-Jones established an early lead in the fast-growing private credit market, while larger ratings firms concentrated on the bigger public bond markets. It has since positioned itself as a leading rater of private credit transactions, assigning ratings to more than 3,200 private credit investments in 2025 with a team of about 25 analysts. How does a team of 25 analysts do the DD on 3,200 companies in one freaking year? It can't be done. In other words, they were just rubber stamping. Pay us enough and we'll call it AAA. And if your investors lose money, I don't care. I collected my fee anyway. And yeah, the SEC is saying, no, you can't grow that business now that there's $500 billion of data center ABS that's about to hit the market. Guys, when the dust settles from what's going on in private credit and private equity and now insurance, thanks to the guy at the Dodgers, you can expect we'll be hearing a lot about Egan-Jones at the congressional hearings that will surely follow from that. But at the very least, man, the regulators showed up to work today. Hey, guys, thanks for coming in. I appreciate that. And thank you guys for having your coffee with the Melonheads this morning. I appreciate that. Don't forget the like button, the subscribe button, the hype button, all that algorithmic goodness that helps the channel, should you feel so inclined. Thank you also to my magnanimous Melonhead members on YouTube, members, Patreon, and Buy Me a Coffee. Links down there, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.